Hello, everybody. In Module 4, I discuss communication games between the managers and the market. Module 4 has 6 lessons. Today, we're focused on Lesson 3, how to model skepticism in the capital markets. In the previous lesson, we already see that markets gives benefit of doubt upon non-disclosure. Such benefit of doubt enables managers with sufficiently bad news to choose to be strategically silent. Investors, however, would be skeptical about non-disclosure. In those models, it is usually assumed that managers either know the firm value perfectly or do not know anything. Therefore, disclosure would be perfectly informative. Investor skepticism applies only to non-disclosure, but not to disclosure. If one wants to study investor skepticism to disclosure, which is pervasive in the capital markets, then one needs to relax the assumption that the manager knows about the firm value perfectly. This is what Xing does in his 1994 Rand Journal of Economics paper, and this is the paper that the discussions in this lesson would be based on. From a big picture perspective, we already said that when the manager may not know the value perfectly, investors would be skeptical even to disclosure. And Xing introduces a smart and tractable way of modeling how the manager may not know the firm value perfectly, may not know the complete truth. And in addition, how to precisely define investor skepticism. In equilibrium, Xing shows that the manager would disclose all good news and suppress all bad news. Investors, in response, are going to apply a belief that is more skeptical than naive Bayesian updating about such disclosure. Now let's look at the setup. The manager chooses the disclosure strategy to maximize firm price upon non-disclosure, which is defined as expected value of the firm conditional on disclosure. And again, no lying is allowed. The firm value X can be from either X1 to Xn, with some prior probabilities P1 through Pn. And there are n possible signals that the manager may or may not observe, sigma 1 through sigma n, and it could be 0 or 1. The realization of sigma would depend on the realization of X. And sigma is either 0 or 1, depending on this formula. Sigma 1 equals 1, because sigma 1 corresponds to the case where j equals 1. And we know because I is from 1 through n, so I must be bigger than or equal to 1. So sigma 1 equals 1. The rest of sigma j can be either 0 or 1, depending on xi. And as in the spirit of the Dai and Zhao and Kwong model we discussed in the previous lesson, manager observes sigma j with some probability theta j. So this may seem a little bit abstract, and I'm going to use an example to illustrate. But in general, this is an elegant way of modeling that the manager learns about some interval in which the true value of the firm lies. So the manager knows some truth, but not the complete truth. And here is the illustrative example. X can be either X1 through X6, with some prior probabilities P1 through P6. And there are 6 possible signals that managers may or may not observe. Sigma 1 through sigma 6 can be either 0 or 1. Now, suppose the manager observes sigma 3 equals 1 and sigma 5 equals 0. Then, this is equivalent to saying that the manager knows that X is between X3 and X4. Because sigma 3 equals 1, which means X is at least X3. Sigma 5 equals 0, means that X must be smaller than X5. That means X must lie in between X3 and X4. And that's the manager's information set, I. The manager cannot lie, but the manager can choose to withhold certain information, which means that manager's disclosure must contain manager's information. So for example, the manager can disclose that X is at least X3, which means that the disclosure can be X3, X4, X5, and X6. That is allowed. But if you disclose X is at least X4, or D equals X4, X5, X6, this is not allowed because you're not sure whether X can be bigger than X4 or not. There are 3 dates of the model. In date 0, X and sigmas are generated by nature. Date 1, manager observes the manager's information set, chooses disclosure with the no lying constraint to maximize the expected firm value, conditional on disclosure. And then at date 2, all the uncertainties are realized. Now let's look at the results. The first result is truthful disclosing is not going to be equilibrium. So D equals I is not equilibrium. So here's why. Suppose that truthful disclosing is in equilibrium, which means that in equilibrium, the market believes that the manager is disclosing the whole truth, disclosing every signal, every sigma that the manager knows. Then the manager would have incentive to not disclose all the sigmas that have zeros. Right? The manager has incentive to not disclose bad news. In this case, the stock price would be higher because if the market naively believes that the manager is disclosing the whole truth, then the market is going to attribute non-disclosure to the manager not observing information. And that is going to achieve a higher price than if the manager discloses bad news. Shing shows that a plausible and intuitive equilibrium disclosure strategy would be the sanitization strategy, which means that all good news are disclosed, all the sigma j equals 1s are disclosed, and all the bad news are suppressed. All those sigma j equals 0 are suppressed. Which means disclosure would be of the form x is at least bigger than some xi. What is the market response? Again, let's use an illustrative example to demonstrate. We're going to see a market would be skeptical than naive beliefs. Again, 6 signals, and disclosure is x is at least bigger than x3. Then we can calculate the posterior belief that x equals x3 conditional on disclosure from Bayes' rule. And to calculate that posterior belief, we need to know the probability of D3 conditional x equals x3, x4, x5, and x6. So let's first look at probability of D3 conditional x equals x3. This probability will equal to theta 3 because you cannot lie when you disclose. So if you disclose x is at least x3, you must have observed sigma 3 equals 1. And that happens with probability of theta 3. And that's what we need for disclosing x is at least bigger than x3. Because conditional x equals x3, even if you observe sigma 4, sigma 5, and sigma 6, those must be 0. And by sanitization strategy, you're not going to disclose this. So whether or not you observe sigma 4, sigma 5, sigma 6, or you do not observe, you're not going to disclose it. So that's why probability D3 conditional x equals x3 is theta 3. The probability D3 conditional x equals x4 would equal to theta 3 times 1 minus theta 4. Why is that? Again, disclosure has to be truthful. So if you disclose D3, you must have observed sigma 3 equals 1. And that happens with probability of theta 3. And you must not have observed sigma 4 because conditional x equals x4, sigma 4 must equal 1. But if you observe sigma 4 equals 1, then you would disclose x is at least bigger than x4 based on sanitization strategy instead of x is at least x3, which means that conditional x equals x4, if you're still disclosing D3, that means you must not have observed sigma 4. And that happens with probability 1 minus theta 4. So the probability of D3 conditional x equals x4 is the product of the two probabilities, theta 3 times 1 minus theta 4. And we can similarly show that probability D3 conditional x equals x5 must be that the manager observes sigma 3 equals 1, but does not observe sigma 4 and sigma 5. So that's why the probability is theta 3 times 1 minus theta 4 times 1 minus theta 5. And we can similarly calculate probability D3 conditional x equals x6. And then we can use Bayes' rule to calculate the posterior belief that x equals x3 conditional on D3. This belief turns out to be more skeptical than naive beliefs. What is a naive belief? Naive belief means that the market takes disclosure at face value, which means that the market thinks that the manager would disclose everything the manager knows. In this case, then the probability D3 conditional x equals x3, instead of being theta 3, would be theta 3 times 1 minus theta 4, 1 minus theta 5 times 1 minus theta 6. First, disclosure has to be truthful. So to disclose D3, the manager must have observed sigma 3 equals 1. That happens with probability theta 3. And if the market naively believes that the manager discloses x is bigger than x3 because the manager has not received signals sigma 4, sigma 5, and sigma 6, then the probability would be theta 3 times the probabilities that the manager does not observe sigma 4, sigma 5, and sigma 6. The market naively believes that if the manager observes those sigmas, which would be equal to 0, conditional x equals x3, the manager would have disclosed. But they do not observe this disclosure, so they naively believes this is because the manager does not observe the signal realizations. That's why you have all these 1 minus theta 4, 1 minus theta 5, and 1 minus theta 6 in the probabilities. We can similarly calculate probability D3 conditional x equals x4 x equals x5 and x equals x6. And then we're going to use Bayes' rule to figure out the posterior belief of x equals x3, conditional on D3 given the naive belief. We can show that this posterior belief, this probability x equals x3 conditional on D3 is smaller than the probability x equals x3 conditional on D3 given the sanitization strategy. What it means is the market belief given the sanitization strategy is more skeptical than the naive belief because it puts more weight on low realizations of the signals. Now, let's talk about how to precisely define more or less skepticism. So the precise definition is in a similar spirit as in Dye and John Kwong. The benefit of doubt of the market comes from the possibility that the manager may not be informed. And this is captured by the parameter theta I, or more precisely 1 minus theta I, which is the probability that the manager is uninformed. That means if theta I is higher, the probability that the manager is uninformed is going to be lower. So there'll be less benefit of doubt, but more skepticism. First, look at some benchmark cases. When theta I equals 0, which means that the manager is always uninformed, then in that case, one can show that the posterior belief conditional on DI would converge to the naive belief. And this represents the least level of skepticism and highest the benefit of doubt. Because in this case, when you don't disclose, I'm going to attribute that to you don't have the news. If theta I equals 1, which means that the manager is always informed, then we can show that the posterior belief converges to the Grossman-Milgram benchmark, which means that when there is no full disclosure, the market is going to assume the worst. So if you disclose X is at least X3, the market would take the belief that X would exactly equal to X3. And this is the highest level of skepticism and the lowest benefit of doubt. When theta I is between 0 and 1, the level of skepticism will lie in the middle. So the value of theta I is an appropriate definition of more or less skepticism. And we can carry out comparative statics of skepticism. If theta I is higher, then the level of skepticism is going to increase. And we can show that conditional on the same disclosure, the price is going to decrease for all the equilibrium disclosure strategy, which means for all the. And intuition is what we discussed earlier. When theta I is higher, the manager is more likely to be informed. The market is more skeptical that non-disclosure is because the manager is suppressing bad news, which means they expect the value of X conditional on disclosure is going to be lower. And here are some empirical implications. Shing shows that higher theta I also causes positive skewness in the distribution of earnings, because higher theta I means that you're more likely to observe information. It means that if you observe good news, you're going to disclose it. If you observe bad news, you're going to suppress it. So that generates a positive skewness in the distribution of earnings. And it also causes lower PE ratio. And that's just because P becomes lower because of more skepticism. Which means that empirical implication of the Shing 1994 paper is that there is a positive association between a skewness in the distribution of earnings and a lower PE ratio. There is a working paper on SSRN almost 30 years ago that confirms this prediction empirically, but it's never published. So there might be some value of digging into this paper again and see if there is any better way of testing the association. And Shing also provides a precise measure of the degree of skepticism to managers' disclosures. And finding a good empirical proxy is valuable because potentially it can be used in various contexts. It can be used in time series variation. For example, the Saban-Oxley increases market confidence, reduces the degree of market skepticism. It can be used in cross-sectional variation of the degree of skepticism. For example, if earnings comes from firms that are perceived lower quality, does market apply more skepticism? Or it can be applied to event tests of degree of skepticism. Does market becomes more skeptical to disclosure after certain events? Examples include missing earnings targets or cutting dividends, etc. To conclude, when managers may not know the whole truth, even when they're informed, they will still exploit the benefit of doubts from the markets because they may be uninformed to suppress bad news and disclose good news, which is the sanitization strategy. And this also provides a theoretically precise definition of market skepticism to disclosure, as we discussed in the previous slide. A development of a good empirical proxy of market skepticism to disclosure will go a long way in capital market research because there are so many settings when this measure could be applied. In the next lesson, we're going to relax the assumption that the manager cannot lie. So far, we have been talking about the manager can withhold information, but the manager cannot lie. If you want to test your understanding of this lesson, a review quiz of this lesson can be found at the link in the slide.